Warren Buffett turned $5,000 into over $100 billion. And he did it using just 3 simple rules. Not complicated formulas, not insider secrets, 3 principles that anyone can follow. And here's what most people miss. These aren't just investing rules. They're a complete framework for wealth building. They transform how beginners think about money. By the end of this video, you'll understand exactly how to apply these 3 rules, even if you've never invested a single dollar, even if you're starting from zero. Ready? Let's dive in. Most people think investing is complicated. Stock charts, financial jargon, risk calculations. But Buffett proved something different over 70 years. The basics work better than complexity. Here's the problem. Financial education in schools teaches everything except how to actually build wealth. So people stay stuck. Earn money, spend money, repeat. No growth, no compound interest working for them. No path to financial freedom. But here's what changes everything. Buffett's 3 rules aren't about getting rich quick. They're about personal finance fundamentals that turn your income into lasting wealth. Rule 1 changes how you think about spending. Rule 2 changes how you think about risk. Rule 3 changes how you think about time. Master these 3. You're not just investing money, you're investing in a completely different financial future. Rule number 1, never lose money. Rule number 2, never forget rule number 1. This sounds simple, but most beginners completely misunderstand it. They think it means never take risks or avoid the stock market. Wrong. Listen to what Buffett actually means. Losing money isn't about temporary market drops. It's about permanent loss. Buying things that will never recover their value. Investing in businesses you don't understand. Chasing trends without research. That's how you lose money permanently. Here's the beginner mistake. Someone sees a stock jump 40% in 1 week. FOMO kicks in. They buy at the peak. They don't understand the company. The stock crashes. They panic sell. Permanent loss. That's not investing. That's gambling. So what's Buffett's approach? Protect the downside first. Before asking, how much can I make, ask how much can I lose. This is money management at its core. If you can't afford to lose it, you can't afford to invest it. Period. Now, here's how beginners actually apply this. Step 1, build your safety net first. Before investing $1, save 3 to 6 months of expenses. This is budgeting 101. Why does this matter? Because if an emergency hits and your money is locked in investments, you're forced to sell at the worst possible time. That's permanent loss. Step 2, only invest money you won't need for 5 years minimum. Short-term money belongs in savings. Long-term money can handle market fluctuations. Step 3, understand before you invest. Buffett's famous quote, "Never invest in a business you cannot understand." Now, if you can't explain how a company makes money in 2 sentences, don't invest in it yet. Do the research first. Want to see this in action? Imagine 2 beginners. Both have $5,000 to invest. The first beginner hears about a hot cryptocurrency, invests all $5,000. The crypto crashes 80%. Now they have $1,000. Permanent loss of $4,000. The second beginner follows rule 1, keeps 3 months' expenses in savings. That's $3,000. Invests $2,000 in an index fund they understand. Market drops 30% temporarily, but they don't panic. Why? Because they have their safety net. They hold. Market recovers. Their investment grows. No permanent loss. That's the difference. Rule 1 isn't about avoiding risk. It's about managing risk intelligently through smart personal finance. Protect your downside. The upside takes care of itself. Rule number 2, don't put all your eggs in one basket. Buffett calls this diversification. But here's what beginners need to understand. This isn't just about owning multiple stocks. It's about building a system that survives when individual investments fail. This is Wealth Building Strategy 101. Listen carefully. No single investment should make or break your financial future. If one company goes bankrupt, you should barely notice. That's true diversification. Here's where beginners mess this up. Someone reads that diversification means own lots of stocks, so they buy 20 different tech stocks. They think they're diversified. Then the tech sector crashes. All 20 stocks drop together. That's not diversification. That's concentration disguised as variety. So what's Buffett's approach? Spread across different types of assets and sectors. Here's how beginners actually do this. Step 1. Start with index funds. One S&P 500 index fund gives you exposure to 500 companies across 11 different sectors. Instant diversification. This is the easiest way for beginners to apply Rule 2 without picking individual stocks. This is foundational financial education that most people never learn. Step 2. Don't ignore bonds. Stocks grow wealth. Bonds protect wealth. A simple mix? 80% stocks, 20% bonds when you're young. As you age, shift more toward bonds. This balances growth with stability. Smart money management means understanding both growth and protection. Step 3. Diversify across time with dollar cost averaging. Don't invest your entire savings on one day. Spread it out monthly. Some months you buy when prices are high. Some months when prices are low. Over time, you average out market volatility. This is wealth building on autopilot. Now listen to this real example. Two beginners each invest $10,000. The first beginner puts all $10,000 into one hot stock they heard about. That company gets hit with a scandal. Stock drops 70%. They lose $7,000. The second beginner follows Rule 2. Puts $10,000 into a diversified index fund. One company in that fund goes bankrupt. The fund drops 0.2%. Barely noticeable. The other 499 companies keep growing. The second beginner's wealth keeps building, while the first beginner is trying to recover from disaster. Here's the math on diversification. If you own one stock and it fails, you lose 100%. If you own 500 stocks through an index fund and one fails, you lose 0.2%. That's the power of Rule 2. So what should you do? Start with a target date retirement fund or total market index fund. These automatically diversify across thousands of companies. They rebalance over time. Set up automatic monthly investments. Let diversification protect you while compound interest does the heavy lifting. Rule number 3. Time in the market beats timing the market. This is where beginners lose the most money. Not from bad investments, from bad timing, trying to predict market tops and bottoms, waiting for the perfect moment to invest. Here's the truth. The perfect moment was yesterday. The second best moment is today. And here's why this matters so much. Compound interest needs time to work its magic. Every day you wait is a day of growth you'll never get back. Want to know the real cost of waiting? The difference between starting at 25 versus 35? Over $500,000 by retirement. That's not a typo. $500,000. Here's the beginner mistake. Someone saves up $5,000. They're ready to invest. Then they hear market crash coming soon on the news. So they wait, and wait, and wait. Meanwhile, the market goes up 20%. They missed out on $1,000 in gains, trying to avoid a crash that never came. What's Buffett's approach? Start now, stay invested, let time do the work. Here's how beginners actually apply this. Step 1. Understand the power of compound interest. This is the most important concept in personal finance. Listen to how it works. You invest $100. It grows 10% to $110. Next year, you earn 10% on $110. Not just your original $100. That's $121. The growth compounds on itself. Over decades, this creates exponential wealth. Now here's the math that changes everything. Invest $500 per month starting at age 25. Average market return 10% annually. By age 65, you have $1.3 million. You only contributed $240,000. Compound interest added over $1 million. Same scenario, but you start at age 35 instead. By age 65, you have $380,000. You contributed $180,000. Compound interest added $200,000. Starting 10 years earlier turned $200,000 of compound growth into $1 million. That's the cost of waiting. That's why Rule 3 matters more than any other rule. Step 2, ignore market predictions. Nobody can consistently predict market movements. Not professionals, not algorithms, not gurus on YouTube. The best strategy? Invest consistently regardless of market conditions. This is money management that actually works. Step 3, never panic sell. Markets drop. That's normal. The S&P 500 has dropped 20% or more 13 times since 1950. Every single time it recovered and reached new highs. If you sold during the crash, you locked in permanent losses. If you held through the crash, you captured the recovery. Listen to this real example. 3 beginners each start with $0. They commit to investing $500 per month. The first beginner tries to time the market, invests during good times, pulls out during bad times, misses the best growth days. After 30 years, $600,000. The second beginner invests $500 every single month for 30 years, never tries to time anything, stays invested through crashes and booms. After 30 years, $1.2 million. The third beginner waits for the perfect time to start, spends 5 years researching and waiting, finally starts investing. After 25 years of investing, $800,000. What's the difference? The second beginner followed Rule 3. Time in the market beat timing the market by $600,000 and beat waiting by $400,000. That's wealth building in action. So what should you do? Open a brokerage account today. Set up automatic monthly investments. Choose a low-cost index fund. Never stop. Never try to time it. Let compound interest and time do the work. Check your account once per quarter, not once per day. Stay the course for decades. Let's recap Warren Buffett's 3 rules that turn beginners into investors. Rule 1. Never lose money. Build your safety net first. Only invest money you won't need for 5 years. Understand what you're investing in. Protect the downside. Smart money management starts with not losing what you have. Rule 2. Don't put all your eggs in one basket. Diversify across companies, sectors, and asset types. Start with index funds for instant diversification. Use dollar-cost averaging to spread investments over time. Wealth building requires protection through diversification. Rule 3. Time in the market beats timing the market. Start investing today, not tomorrow. Let compound interest work for decades. Stay invested through market ups and downs. Never panic sell. This is the financial education that creates millionaires. Now, here's what most people miss. These 3 rules aren't complicated. They're simple. But simple doesn't mean easy. The hard part? Actually following them. Staying disciplined when markets crash. Resisting the urge to time the market. Keeping your money invested when everyone else is panicking. That's what separates.